Welcome to an investigation into some of the most audacious financial betrayals in history. We're going to examine how greed, deception, and a shocking disregard for ethics led to scandals that rocked industries, cost billions, and fundamentally reshaped our understanding of corporate responsibility. Our journey begins by defining what exactly constitutes a financial scandal, according to various sources. According to Wikipedia, a corporate scandal involves alleged or actual unethical behavior by people acting within or on behalf of a corporation. These events are not just about mistakes, they involve deliberate actions. Such behavior often leads to severe consequences, not only for the individuals involved but also for the entire company, its employees, and its customers, as noted by the prime asset. A specific type of corporate scandal, accounting scandals, as defined by Wikipedia, arise from intentional manipulation of financial statements. This isn't accidental bookkeeping errors. It's a deliberate attempt to misrepresent a company's financial health. The disclosure of these financial misdeeds often triggers a much larger corporate crisis, fundamentally shaking investor confidence, as various sources confirm. These scandals, stemming from fraud, deception, or catastrophic mismanagement, don't just cause financial losses. As deep sources highlight, they also eroded public trust in institutions. The ripple effect can be immense, leading to thousands of lost jobs and billions of dollars paid in fees and reparations, according to news sources. This underscores the profound societal impact beyond mere monetary figures. It's easy to be enticed by the prospect of fast and significant money, as Insider Monkey reminds us. However, when it comes to finances, a critical lesson often emerges: when it feels too good to be true, it is. This simple adage serves as a powerful warning against schemes designed to deceive, and it applies to many of the cases we'll explore today. Before we delve into specific cases, let's define a crucial term: the Ponzi scheme. Named after one of its most infamous perpetrators, Charles Ponzi, this is a form of fraud that lures investors and pays profits to earlier investors with funds from more recent investors. There is no actual legitimate business activity generating returns, it's simply a circular flow of money, as described by various sources like World Finance and LearnSignal. Let's break down the mechanics of a Ponzi scheme into a few key steps. First, the fraudster promises high financial returns, often with little or no risk. Second, early investors are paid out as new investors join the scheme, creating an illusion of profitability and success. Third, the scheme requires a constant influx of new money to sustain itself. Finally, it inevitably collapses when the flow of new investments slows, exposing the fraud. This cycle of deceit is a recurring pattern in financial history. Our first major case takes us back to 1919 and an Italian immigrant living in Boston, Charles Ponzi. World Finance and LearnSignal both identify him as the architect of the original Ponzi scheme. His methods were so distinctive and infamous that his name became synonymous with this specific type of financial fraud. It's a rare distinction for a criminal, demonstrating the magnitude of his deception. Charles Ponzi's scheme initially involved speculating on international postal coupons. He promised investors extraordinary returns, far beyond what legitimate investments could offer. As LearnSignal explains, his crooked tactics were so notable that we still refer to them by his name today. He exploited the desire for quick wealth, convincing many that they could achieve immense financial gains with little risk. Shifting from classic Ponzi schemes to accounting fraud, let's look at the waste management scandal of 1998, as cited by Top 10 Accounting Scandals. This case involved significant misstatements of the company's financial earnings. According to deep sources, the causes included cosmetic accounting gimmicks on quarterly balance sheets, making the company appear far more stable than it actually was. Waste management executives systematically inflated the depreciable lives of their assets and failed to record expenses related to decreasing asset values. These actions, classified as creative accounting, served to artificially boost the company's reported profits and assets. This kind of financial misrepresentation allowed the fraud to continue for years, misleading investors and regulators alike, according to Webb and Deep sources. One of the most infamous names in financial scandal is Enron. The Enron scandal exploded in 2001, becoming one of the most high-profile accounting scandals of all time, as highlighted by accounting fraud examples. Once the darling of Wall Street, Enron Corporation, an energy, commodities, and services company, experienced a dramatic collapse due to widespread fraudulent activities, according to Webb sources. Enron's fraudulent activities involved multiple financial offenses, as stated by Webb sources. These included the use of special-purpose entities to hide debt and inflate earnings. The company used mark-to-market accounting, which allowed them to record potential future profits from long-term contracts immediately, often leading to wildly optimistic projections. This deceptive accounting made Enron's finances seem much healthier than they truly were. The unraveling of Enron didn't just bring down the company itself. Its collapse also took with it the massive accounting firm Arthur Andersen, as noted by web sources like Wikipedia, and how accounting scandals have shaped modern accounting. This highlights the extensive network of complicity and the systemic failures that often accompany such large-scale fraud. The fallout was devastating for thousands of employees and countless investors. Just a year after Enron, the WorldCom scandal broke in 2002, marking another colossal failure of corporate ethics. WorldCom, a telecommunications giant, became another massive company torn apart by financial fraud and scandal, as reported by web sources like fraud cases that caused huge. This scandal further solidified the early 2000s as a turbulent period defined by unprecedented corporate deceit. WorldCom engaged in massive accounting fraud, primarily by improperly capitalizing operating expenses, treating them as long-term investments. This tactic inflated the company's assets and profitability while masking its true financial struggles. The company also used bogus accounting entries to boost earnings, ultimately leading to billions of dollars in fraudulent balance sheet entries. This level of deception required significant internal complicity. The year 2002 also saw the unraveling of the Tyco scandal, another high-profile case of corporate malfeasance. Tyco International, a manufacturing and services conglomerate, became embroiled in a scandal involving its top executives. As listed by Top 10 Accounting Scandals, this was another major accounting scandal of the early 2000s, further highlighting a pattern of unethical behavior at the highest corporate levels. The Tyco scandal involved accusations that CEO Dennis Kozlowski and CFO Mark Schwartz embezzled hundreds of millions of dollars from the company. They allegedly used company funds for lavish personal expenses, unauthorized bonuses, and secret loans. This was a classic case of corporate resources being diverted for personal gain, betraying shareholders and employees, a common thread in many of the biggest financial scandals, as noted by multiple sources. Fast forward to 2008, and we encounter one of the largest financial frauds in history, the Bernie Madoff scandal. The FBI describes the Bernie Madoff case as history's biggest financial crime. Madoff, a former stockbroker, orchestrated a massive Ponzi scheme that bilked investors out of an astonishing $64.8 billion, as detailed by Digital Defined and Illinois CPA Society. This dwarfs all previous Ponzi schemes. For decades, Madoff ran his massive Ponzi scheme under the guise of a legitimate and highly successful investment firm, Bernard L. Madoff Investment Securities LLC. He promised consistent, high returns, often around 10 to 12% annually, even during market downturns. This unwavering performance was the primary lure, convincing thousands of individuals and institutions to entrust him with their life savings and capital, as highlighted by Webb and Deep sources. Madoff's scheme was remarkably simple at its core, relying on an ever-increasing pool of new investors to pay off the old. He didn't actually invest the money, he simply deposited it into a single bank account and used incoming funds to satisfy withdrawal requests. The FBI notes that if clients knew each other and ever compared statements, the numbers had to match the illusion, but few did, enabling the fraud for years. More recently, the wirecard scandal erupted in 2020. Wirecard, a major German fintech company, was revealed to have fabricated almost $2 billion in revenue, according to Sufio. This amounted to the biggest accounting scandal in Germany's history and sent shockwaves through the global financial technology sector, as Medium and other web sources confirm. It highlighted that even modern, high-tech companies are susceptible to old-fashioned fraud. The heart of the Wirecard scandal was the disappearance of $2 billion that was supposedly held in trust accounts in the Philippines. Auditors could not verify the existence of these funds, leading to the admission that they likely never existed. This massive hole in their balance sheet exposed years of systematic fraud, resulting in the company's collapse and the arrest of several top executives, as numerous web and news sources reported. These scandals often highlight critical failures in auditing and oversight. The collapse of Enron, for instance, famously took down its auditor, Arthur Andersen. Deep sources confirm that accountants have played an outsized role in facilitating recent international financial scandals. This underscores the immense responsibility of auditors and regulators to ensure transparency and uphold financial integrity, often requiring them to probe deeply. When discovered, these financial scandals have a devastating impact. As the Prime Asset notes, they have a huge effect on the entire company, including its employees and customers. News sources further clarify that the biggest accounting fraud and financial scandals in history have caused thousands of lost jobs and led to billions of dollars paid in fees and reparations. The human cost is often immense. Beyond the immediate financial and employment consequences, a pervasive side effect of these scandals is the eroded public trust in institutions, as highlighted by deep sources. Each major scandal, from Enron to Madoff, chips away at the public's confidence in the financial system, corporate governance, and regulatory bodies. This makes it harder for legitimate businesses to operate and for investors to feel secure. Despite their destructive nature, these cases have ultimately reshaped the business landscape and pushed for stronger investor safeguards, as news sources report. Each major scandal acts as a catalyst for reform, leading to new regulations, stricter oversight, and enhanced corporate governance practices. The aim is to prevent similar frauds from happening again, though the challenge is ongoing. The Wirecard scandal of 2020, among others, highlighted the importance of transparency, accountability, and ethical behavior in the financial sector, as noted by Medium. These principles are now more critical than ever. Transparency ensures that financial dealings are open to scrutiny, accountability holds individuals and corporations responsible, and ethical behavior forms the bedrock of a trustworthy financial system. As financial systems evolve, so do the methods of fraud. News sources state that the tools and techniques behind financial fraud have evolved, yet its impact remains as destructive as ever. From inflated profits and fabricated stock trades to emerging cryptocurrency scandals, the ingenuity of fraudsters keeps pace with technological advancements, requiring constant vigilance from regulators and investors alike. As the financial world continues to evolve, spurred by technology, innovation, and increasing global interconnectivity, the risk of future scandals remains ever present, as Digital Defined warns. Financial fraud is as pervasive as ever, according to news sources. This underscores that eternal vigilance is required to protect investors and maintain the integrity of our financial markets. What are the key lessons for investors? The recurring theme, reiterated by Insider Monkey, is that it's sometimes easy to be allured by a prospect of fast and big money. When it comes to finances, oftentimes, when it feels too good to be true, it is. Due diligence, critical thinking, and a healthy skepticism towards promises of unrealistic returns are paramount for protecting one's investments. The history of financial scandals is a stark reminder of the constant tension between ambition and ethics. From Charles Ponzi's early 20th century deception to the modern complexities of Wirecard, the patterns of fraud and its devastating consequences echo through time. As we conclude our investigation, it's clear that the fight for transparency, accountability, and ethical conduct in finance is an ongoing battle, one that shapes economies and societies.